Broadcast has now started. Hi everyone, thank you for joining the Carbon and Investment Implications for Fiduciaries webinar, hosted by the Intentional Endowments Network and Common Fund. I'm Jackie Smith, Senior Fellow with the Intentional Endowments Network, and today we'll be joined by Common Fund experts Jess Gaspar and Ethan Levine, who will discuss insights from the extensive research that they've done over the past 2 years into how to best address the challenges of low carbon investing across both public and private markets. Jess Gaspar is Managing Director and Head of Asset Allocation and Research at Common Fund and Lead Portfolio Manager on their low carbon strategy. Ethan Levine is Director at Common Fund and primarily works in the firm's natural resources programs while also contributing to the private equity, venture stress capital teams. Next slide, please. Today's agenda will be a brief summary on who we are at IAN, and then Jess and Ethan will discuss identifying, measuring, and managing risks and opportunities from potential taxation, regulation, and technological progress, and implementing a solution that preserves fiduciary responsibility. Then we're going to end with a moderated Q&A. Please send your questions via the chat function at any time during the webinar, and then we'll compile them and get through as many as we can at the end. Next slide, please. The Intentional Endowments Network is a broad-based collaborative network advancing intentionally designed endowments through a variety of strategies, including ESG integration, impact investing, and shareholder engagement. IAN engages key leaders and stakeholders in higher education, business, and nonprofit sectors. It provides opportunities for education and training, peer networking, convening, thought leadership, and information exchange. Next slide, please. The network undertakes strategic activities in a coordinated way to ensure specific actions are part of a broader context moving all of higher education and society towards sustainability. Additional upcoming activities and information exchanges through IAN are a webinar on October 19th discussing transitioning to integrating investment practices with program mission, and also the Intentionally Designed Endowment Forum at Loyola University in Chicago on November 1st and 2nd. Links will be provided at the end of this webinar to sign up for those as well. With that, I will hand it over to Managing Director Jess Gaspar.
Thank you, everyone, for joining us today. Start off with a reminder of last year's headlines, which was really quite an amazing year for climate change headlines. We had the December Paris Agreement on climate change. We had Pope Francis's encyclical on climate change. We had France's mandatory carbon reporting, as well as New York Attorney General Eric Schneiderman's subpoena of ExxonMobil for climate change conflict of interest. And then this year in 2016, while some of the headlines have been slimmer, we have the hottest year on record. So certainly quite a lot of important information coming forward about the risks of climate change and what we as investors need to think about as we structure our portfolios. Next slide, please. This is a simple plot that I think many of you are familiar with already. We have carbon dioxide concentration in the atmosphere on the right side axis, and we have global temperature on the left axis. It's roughly the last 150 years. What we see is carbon dioxide concentration rising from about 290 parts per million up to today would be over 400 parts per million. At the same time, we see a significant rise in temperatures. This has been, as I mentioned, broadly discussed, but let's take a little bit of a further step back in history. Next slide. We now go back 800,000 years. Again, we have carbon dioxide concentration on the left in blue, and the temperature in Celsius versus the 1,000-year average on the right in red. We see cycles in carbon dioxide and in temperature. We notice that the carbon dioxide tends to lead temperature. And furthermore, that these cycles have been reasonably well contained. That is, until recently. In recent years, we've had a breakout to the upside in the carbon dioxide concentration in parts per million. So if we look back over those 800,000 years, that tells us that the last 40,000 generations of humans have never seen this level of carbon dioxide concentration. Indeed, no Homo sapiens has ever seen this level of carbon dioxide concentration. You have to go back to Homo erectus to find a hominid who has experienced this level of carbon dioxide. Next slide, please. So let's think forward now that we've looked backward. The IPCC estimates that in order to have a 2/3 chance of meeting our 2-degree carbon objective, we can emit, roughly speaking, about another 750 gigatons of carbon dioxide into the atmosphere. We are emitting currently about 37 gigatons a year. So that means at current rates, we have 20 years left. We have on the chart here probable reserves for oil, gas, and coal. Probable reserves are measured as fossil fuels in the ground that will likely be recoverable with a 50% chance under current technology. That's the dark blue columns. We also have in light blue ultimately recoverable resources. Those are resources that are likely recoverable given the future development of technology. It turns out that probable reserves, oil and gas combined, already exceed the 750 gigatons that the IPCC suggests is what remains of our reservoir. If we just add in the probable reserves of coal, we're now at 4 times the level that can be emitted through 2100. So that suggests some real issues for investors. It makes us think about stranded assets for companies that own natural resources, impaired assets for those who use them, and I think quite importantly, stranded business models for a variety of companies who will face a different carbon future than the one they might have been planning for even 10 years ago. Next slide, please. As we think about building low carbon solutions, we're really focused on 3 primary drivers of fiduciary duty. The first is mitigating carbon risk. Carbon risk is important because as some of those assets, which are priced in the market, are revalued, the value of companies that we invest in, the equities or perhaps even the bonds, will be reduced. The 3 primary drivers of risk are carbon taxation, government regulations, and technological progress. Most conversations focused on carbon taxation, such as the carbon emissions tax mooted by President Obama last year. But regulation is already happening. The Clean Power Plan, although stayed, has real teeth and is making a significant difference in the business model of utilities. The Massachusetts Supreme Judiciary Court, the U.S. Court of Appeals, and a number of other state and federal agencies have already had rulings about requirements for states and federal institutions to both meet emissions reductions objectives and incorporate social pricing of carbon into policy formation. But perhaps even more important than taxation and regulation is the tremendous rate of technological progress, which is seeing renewable energy and downstream applications become rapidly competitive with existing alternatives. I think the clearest example here is photovoltaic solar cells, which in 1977 cost $77 a watt to produce. And a couple of years ago, we're down to 73 cents a watt, a 100-time reduction. That technological progress is not just upstream in the generation of power through solar and wind. It's about infrastructure and smart grids with a network of 2-way flows of power based on real-time intelligent data and smart switching. It's about new processes for airlines who need to reduce their emissions through their planes. It's about new industrial processes for cement and for steel. There's a whole range of industries that are ripe for disruption along the value chain. So then once we've taken advantage of these opportunities and we've tried to mitigate the risks, we then, as fiduciaries, need to roll back and manage the total risk in the portfolio and examine the volatility and make sure the volatility of our low carbon solutions correspond with those in our carbon agnostic portfolios, and make sure that the tracking errors are well managed and that the factor exposures don't bring any surprises, unintended surprises to bear. Next slide, please. So as we look at those opportunities, this slide illustrates really three primary drivers. The first is energy generation, the upstream production. The second is energy efficiency, the actual use of the energy. And the third is non-energy sustainability, which increasingly is related to energy and also may be an important source of carbon in the atmosphere. So on the energy generation side, the renewables, we know that wind is now cost competitive in parts of Texas, the home of U.S. fossil fuels. The levelized cost of energy in wind has come down by 60% over the last 5 years and is expected to diminish at a similar rate going forward. Solar photovoltaic cells are also diminishing rapidly. And then with the Tesla's Gigafactory, we're seeing rapid rates of cost reduction in batteries as well. We move on then to efficient transportation with electric cars and self-driving cars, efficient buildings and construction. The Empire State Building's retrofit reduced its carbon footprint by 38%. And then energy conservation in our homes with Nest, or for utilities themselves with O-Power. So there are tremendous opportunities for investors appearing here if they're wishing to take advantage of positive opportunities in the investment marketplace. Next page, please. So alongside taking advantage of opportunities, we want to be mitigating our risks. As we think about those risks, we have a very simple model for it, or at least what it would appear to the outside to be quite simple. Let's think about carving the economy up into a sandbox. And for those sandboxes, we look at the individual squares. We carve it up into a grid of squares, and we identify the carbon footprint of those squares using three rules: affinity, volume, and intensity. The affinity rule essentially identifies squares that have a lot of carbon in them. Because there's such a problem with reporting currently, we need to be skeptical of the data that's available to us. So when we carve that sandbox up into squares, it's comprised of companies that look clean and companies that look dirty. But if you're in a very dirty square, we knock you out entirely. Strong incentives for misreporting, such as we know with Volkswagen. The second set of rules, volume, is intended to find large emitters that are sitting in clean squares, in clean boxes in the economy. So we look across all the clean boxes and we find large emitters and we knock those out as well. This is important because we know that both regulators and activists have significant impact on companies with large footprints because they have deep pockets to provide resources for improving the environment, and they also capture public attention. The third rule is an intensity rule, and we should think about that as identifying high cost relative to benefit companies, companies with large emissions or reserves relative to some measure of value. Those can be thought of as the black holes sitting in the sandbox. So the combination of identifying areas which tend to be dirty, of identifying large emitters and large owners of reserves, and of finding companies that have lots of emissions and reserves relative to the value they contribute to society, can provide a pretty good, robust screen for identifying where the largest carbon risks are in your portfolio. And these can then be tailored to your preferred reduction in reserves and emissions in exchange for having a smaller universe of companies and market capitalization. Next slide.
Thanks, Jess. This is Ethan Levine. So I'm going to switch gears and talk about how we're thinking about this within a private capital context. And so our private capital group covers a broad range across the spectrum from private equity to venture capital to private natural resources. And what we were doing is we were trying to think through kind of how we could provide a solution to our clients across the impact investing mandate. And as we reflected on it, we thought it was critical at the end of the day to deliver a solution that delivered financial risk-adjusted returns on a standalone basis. And that needs to be, if you have to take away anything, we think that that's a critical piece of any kind of investment solution. And why is that? Because when people look at impact investing, they sometimes create a connotation that you have a trade-off between returns and impact. And we think it's important as fiduciaries to deliver that financial return on a standalone basis. The difference with this mandate versus some of our other mandates is that in addition to that financial return, it delivers a measurable environmental metric on top of that. So something like number of tons of carbon displaced or number of acres of land conserved. And that in aggregate gives the total return. And so the goal there is to do good and do well at the same time. What's been challenging for, I think, a lot of institutional investors, a lot of our clients, is that they don't want that trade-off. And so having that kind of critical standalone financial return is important. And demonstrating that you can generate that with data over time is equally important, because that's kind of the evidence that folks need to see. And admittedly, the data is limited and it is a hurdle, but we see it increasing with time. Next slide. So digging in a little bit deeper, we constructed an environmental sustainability solution, and it covers the 3 modules and 3 areas that Jess kind of described earlier. And kind of why did we decide to focus on these particular areas within environmental sustainability? I'd say it's a combination of 2 reasons. One, we think it leverages our internal skill set, and 2, we thought it could actually be areas where we would be able to find attractive financial risk-adjusted returns. And I'll dive into deeper into each of these areas in a little bit. But what we did was we mapped out the universe across these areas and found over 300 different opportunities, and we filtered it down to a handful of interesting ones. Admittedly, it's a limited data set, and we tried to be comprehensive across those areas, but there's only so many opportunities that we found to be interesting and deliver those attractive financial risk-adjusted returns. Next slide. So talking a little bit more about the first module of renewable generation, Jess described this a bit, and what we see here on the private side are kind of operating platforms that are more infrastructure-based. So think wind farms, utility-scale solar. It's more of an infrastructure type return. You can have some exposure to some project development, which could increase some returns, and you would expect some form of current yield in this particular module. The risk-return profile does differ here by geography, and it's not just by country, but even just within the U.S. As Jeff mentioned, wind does work in Texas, but it may not work as well in Connecticut, where we are. So that's an important consideration when making investments in any of these types of structure operating platforms. The chart on the lower left kind of depicts graphically the effect that Jess described earlier regarding the decrease in cost of solar photovoltaic. And it's quite dramatic, just even over the past 15 years. And the trend line thereafter, you can see that it actually, in our estimation, will continue to decrease. And we think that, combined with the chart on the right, which is the demand that we could expect to see going forward, continuing to rise, and that, admittedly, it's regulatory driven to a certain extent, tax credits, renewable portfolio standards, but it's also economic too. And so the combination of increased demand with a lower cost supply is, in our minds, very interesting, and we're beginning to now see things at grid parity in different parts of the world, and to us that's more of an attractive risk-adjusted return. Next slide. The second module, energy efficiency, this would be more kind of growth equity or even some later stage venture companies focusing on delivering solutions that are more energy efficient. And historically, this module has been more challenged. Clean tech investments just haven't performed well. And as we look forward, we don't believe that combining capital intensiveness with a more venture capital model works as well. So our bias would be towards more kind of capital efficient business models, later stage companies that have proven technologies. We're not looking to finance just a bunch of science projects. And so the companies Jess mentioned earlier, Nest, O-Power, those would be companies that we have had exposure to in our venture portfolio. And that's the type of exposure we would look to generate within this module. And if I draw your attention to the bottom right, that graph, what gets us excited about this area is that we could talk about reducing emissions and doing so through replacing coal generation with renewable generation or even natural gas powered. But we think that actually a lot of the emissions reduction is going to come from energy efficiency or reducing energy intensity across our economy. And so this is an exciting way to kind of play that investment theme going forward. Next slide. So this third module is a little bit different, sustainable timber and agriculture, and it leverages kind of some of our expertise in the natural resources space, and it's focused on providing more functional carbon sinks. And what we would focus on within this module is areas like upstream agriculture, crops, dairy, cattle, farmland, timber stands, and water. We see there an increasing opportunity set there in things like water conservation and wastewater management. And there's some interesting niche here, admittedly, opportunities here. So things like conservation easements and timber, grazing land regeneration, wetland mitigation banks to offset industrial development. And if you look at the bottom right, here's an example of something in the land regeneration front. And it's not just about planning effectively. It's about differentiated land management and actually getting paid for it. So this picture shows two different approaches to sheep grazing in Australia. And the more innovative approach on the left, it's not, I wouldn't say it's rocket science or anything, but you're basically just rotating the sheep through different land tracts and being able to preserve the growth on that land, versus on the right side where you're not doing any kind of land management. And in a place like Australia, you can actually get paid for this. And so they have a multi-billion-dollar fund that provides farmers a stipend for offsetting carbon using this new generation technique, and you get paid as much as $8 to $10 per ton of carbon displacement. So, I think these are the types of things where you have the opportunity to do good and do well at the same time. But maybe I'll pause here, hand it back over, and see if there are any questions that Jess and I can take.
Thank you, Jeff and Ethan. Now we will go to the questions that the audience has entered throughout the presentation. And the first one is, how much of an impact do you see the Paris agreements having on investor expectations on carbon risk? And do you think those expectations are different in the US, in Europe, and the rest of the world?
I guess I'll take that one. This is Jess. I do think that the Paris Accord is having significant repercussions. I believe India recently became a signatory this week. There are lots of countries that are making commitments to carbon dioxide reductions or maintenance levels, and this is going to flow through to implementation. There are going to have to be changes in business models and changes in technologies, and that is going to have implications for profits and losses generated by companies and for the valuations of those companies. A recent very interesting example I alluded to earlier was the Massachusetts Supreme Judiciary Court earlier this summer ruled that when Massachusetts set a objective in legislation to reduce its carbon emissions by 25% relative to 1990 levels half dozen years ago, the politicians began to talk about it as an aspiration, and the Massachusetts Supreme Judiciary Court said this must happen. It's in legislation, and furthermore, you have to identify year by year what the individual institutions who emit are going to reduce their emissions by. So that's an instance where we are seeing it happen. And I think that the importance of the Paris Agreement was the broad commitment, the broad sense in which everyone is a participant in this, and that it will have a snowball effect and grow into something significantly larger.
And I would just add that the big uncertainty to that is going to just be the timing. So I think a lot of these things will be implemented, it's just when. And so you look here in the U.S. With the Clean Power Plan being tied up in the Supreme Court, and when that's resolved, how that's resolved, it's uncertain. And so that's why at the end of the day, when we're looking for investment opportunities, they have to stand alone outside of just kind of regulatory benefits, et cetera. And so look, you have to take a point of view on the regulatory side, but that's why some of these things are becoming more exciting in our mind, because they're beginning to look interesting on a standalone basis.
Right, you have to go in with a skeptic's view, I would argue. It's awfully tempting to want to invest in things because they sound good, but we need to verify that they make good economic sense and that the set of assumptions we're employing to get there are reasonable.
Okay, thank you. And we have a couple more. Should small, low capital fiduciaries accept the present risk protection from funds with fossil fuel diversification?
If I understood the question correctly, the inquiry is whether or not the diversification benefits from fossil fuel investment in an equity portfolio are substantial enough to outweigh the looming carbon risks that may appear due to global warming. And that's how I'm going to answer it. I think when we look at the diversification benefits of energy, we shouldn't overstate them. Let me just give a very simple example. It's a little bit mathematical, so my apologies, but we know from the fundamental law of active investing that your ability to generate good performance is proportional to the square root of the size of the investment universe. So if we think that, for a round number, which is not too far from the truth, energy and materials are about 10% of the global equity markets, and you pull those out of your portfolio, your performance would be reduced by the square root of that number, so about 5%. So as we look at active management, as we look at diversification, we're talking about a 5% reduction in performance. So if you thought you're going to get 8% outperformance, now you might get 7.6. That's an important number. It's worth considering. But it's not as if it's going to chop your returns in half. It's a manageable number. And I just proposed the simplest minded approach to that problem. I just said, let's lop out all of energy and materials, which makes no sense, I think, to anybody who's an investor. So more thoughtful, more nuanced approaches can probably significantly reduce the impact on your performance. There is a trade-off. I think oftentimes, though, our reaction in thinking about either screening or reducing the available investment universe in our portfolios is that we should never go down that route, and it becomes almost ideological. I think in practice, it is a little bit of a cost, a little bit of a benefit. To the other side of the story, if we were to put a $10 ton emissions tax on all of the MSCI equity companies that have emissions, it would wipe out 3% of their profits. And if we put it at the socially efficient level estimated by the government of $37 a ton, that would wipe out 10% of their profits. That's a much bigger effect than screening out a small proportion of the companies that are in your universe. So I think oftentimes, if we go deeper in and we identify the primary sources of risk, we can use that to our advantage.
Thank you. And we have one more. Many ESG dedicated funds have histories of high volatility that expose small endowments to larger risk than non-ESG focused funds. Will the volatility decrease over time, and should the small endowments hold off on investing in ESG dedicated funds until then?
Well, it would always be good to know what volatility is going to be in the future. I sympathize with that question. I think that right now, ESG is still in its formative stages. Certain dimensions of ESG have gone very far. We know from the academic literature that governance has been under consideration for a long time, and standard, undifferentiated approaches to improving performance through governance are probably not a great opportunity. On the other hand, we also know that because it's in its infancy, that there are opportunities for more differentiated, more thoughtful approaches, that by getting deeply into the underlying considerations, we can outperform potentially. I would argue that areas where the investments are not perfectly clear, where the opportunities are hazy, where it's murky, the data is ugly, it's hard to get, nobody's there, that's where you should be going. That's where you should be looking for opportunities. So what I would suggest is, while ESG opportunities may not be fully mature, that's probably a good reason to look into them, but to be skeptical at the same time.
Okay, great. Thank you both very much, and thanks to everyone that participated in the webinar. There will be a recording posted of the webinar on the IEN website, where you'll also find the links to our upcoming events in October and November. And again, our website is www.intentionalendowmentsnetwork.org. And thank you again, and we hope to see you at the next event.